Good evening to everyone. Do you hear me properly? Hello. Do you hear me properly? Hello. All right. Then we will start the session for today. All right. Last week, we discussed about the concept of value and what value, a corporate value, how value is generated cooperatively, that is together. Uh, um, together together value can be created in many forms, but here we take the basic corporate value creation. So that is a value creation in a limited liability company, a firm. Then how best we manage it and how the value is being generated. You have learned this in this subject, in other subjects as well. Different interpretations are also given for value. But last week we discussed and understood that value can be formed in many ways at, again, many different levels and at many different times, where we focused on the value chain, or the value is connected to each other when we take the final value. The meaning of value also we discussed. Um, then before moving on to strategic valuation, please keep in mind that the strategic valuation is going to focus on the value of a corporation as a whole. That means the accumulated summation of all the values together. The aggregate value of a corporation is discussed under strategic valuation. But for strategic management accounting, you need to understand the importance of strategic valuation and the different dimensions and aspects of valuation what we discussed last week, and even value concepts explained in textbooks and all at micro level as well. So this is the macro level analysis. Micro level analysis tells or gives you some information about how the value is created. But it's a fact, especially in the market economy, the stakeholders who contribute for the value do not have full access to information. For example, in the course of production of goods, Lots of things are there. Your owners, managers, employees, suppliers, even consumers. Finally, they are the people who are going to buy the things, environment, government agencies, general public likewise. So you may name any. So lots of stakeholders are there, but very rarely, most of stakeholders are aware of the information of the value creation. Only the very few knows how the value is created and value is distributed. So who are they? They are none other than the managers, top managers and board of directors. So that's why to great extent, value creation model or the value chain is criticized from an alternative perspective. But if you read the orthodox, or I mean what's available in the market or textbooks, which always focus about this orthodox or traditional organization, where they presume that managers are the only people they should know, board of directors are the people they should know about information, therefore they manage it, others will have to contribute and be satisfied with how the value is distributed to them. Actually this strategic or the value chain analysis, if the value chain analysis is looked at from a critical perspective, lots of things are there for us to discuss. So we expect from you guys not to look at the value creation process, value chain only from the traditional or institutionalized and most frequently seen in textbook, the concept seen in textbooks. Instead, alternatively, look at the concept from other different perspectives. So at the end of today's strategic valuation, I will discuss some of the alternative models for strategic valuation as well. So I hope it's clear. If it's not clear, please ask. Today's discussion, the strategic valuation, focuses from a macro perspective, where we look at how the value has been created within the organization as a whole, one entity unit. But before coming to that, through strategic management accounting, different value creation, in a way we can't say model, the ways in which value is created and different times of processes. So lots of things are there. A lecture is only a guide for you to understand. Actually, if you want to learn the strategic value creation and strategic management account, the role of strategic management accounting in value creation, you need to read a lot, including research papers, textbooks, and all. Nowadays, you are assessed for your group performance, that is the group presentation based on a given research article. You are supposed to make a presentation plus a small brief. Already 2 weeks gone, but my experience about the students' performance in a way that is also a bit traditional. If you have already presented the paper, can't help it's gone. If you want to get good marks or the score for your performance, you need to um, deviate from traditional presentation mode. We do not expect you guys to simply read out presentation slides. Unless you read the paper properly, understand it, summarize, and explain us what kind of management, strategic management concepts have been discussed, its implications and all these things, because it's not a research that you have done. It is a simple task. Someone else or maybe some scholars have done a research, then you explain it. So, but in my group, so the performances were not up to the standard. For your benefit, like then you can change strategy then in a way that's unfair for those who have already presented. But anyway, so this is not something that we engage in fierce competition. This is a learning process. Sometimes we go wrong, but whatever, we have um, yeah, 1 minute, that's a message. Right. Okay. So I hope the screen also visible to you properly. Let me change it to presentation mode. Strategic valuation. Um, so how are we going to value the final valuation as a whole an entity? Actually, there are two ways of assessing a business. One is to assess the um, residual value of a business. So that's the um, business value. From owner's point of view, you know that business operations are financed by owners and lenders. When we talk about business valuation, that part of value which is claimed by outside lenders should be reduced. So therefore, from the value, we need to deduct the value of a debt. So this is how we reach to business valuation. So from investors' point of view, who owns the business? So of course, lenders and shareholders have invested money. Then we can argue that yes, both of them own, but it's not like when it comes to legal personality. If you have borrowed some money, they will never become owners of the company, even though their money has been invested in the capital, in the long run use of the company, and they are mere lenders. That's why they are treated as creditors or liabilities. So that has to be carefully understood. So that valuation is the business valuation as a whole, like in case if you want to buy and sell businesses, like businesses in the sense entire organization. The other part or other aspect of the valuation is the enterprise value. Enterprise value is the value of the capabilities of the entity, simply disregarding who have financed it, no matter whether it has been financed by lenders or equity, what proportion, we simply disregard. Then we assess the capability of the enterprise. So enterprise value, where we do not deduct the value of debt holder, because we assess the enterprise value as a going concern, not for the purpose of selling the business, where the capacity will be assessed. Now, we look at how are we going to value. Last week, also we discussed what really drives value. Is the value as of now that we have or future value? Different arguments are there. Even future value, there is no point of valuing the future is highly uncertain. If you say that in 10 years time the value of your business is this much, no one is going to buy at that price because that's highly uncertain. We do not know whether it would be realized. Again, as of now, this is the time at which you are going to pay the price. So therefore you are not in a position to pay that much. But future values, so the forecasted values, should be discounted, normally are discounted to present value, whereby the present value would be taken as a guide or a base for negotiation. So in that explanation, the basis for valuation is taken from forecasts, future. But forecast is not done in imagination, not dogmatic forecasts. We have to forecast based on realities. It should be pragmatic. That is why we need to take into account the present situation, current situation, present state, like the financial position, capabilities, and then we do the forecast. Okay. How long Should it be for 10-year, 25-year, 50-year, or for infinite time period? Another big issue that we are facing as far as a legal person is concerned, corporate is concerned, it's presumed lifespan is infinite. It's like intangible legal person, or the legal person without having a physical substance, actually. Its life is infinite. So therefore, your time horizon is infinite. So infinite time horizon, end is unknown. If the end is unknown, it's extremely difficult for us to assess because we do not know what would be the end. Therefore, it's good relative to infinite valuation. If you can identify the time horizon and set it for a finite time period, our valuation preciseness of valuation would be much better than in a case where we consider infinite valuation. However, lots of models have been developed for infinite valuation, especially in the field of finance. I hope you have already learned some finance subjects as well. Right. So simply speaking, argument here is we do the valuation based on forecast. If we can identify a finite time horizon with the preciseness, so that is much better. But depending on the situation, we need to think of other alternatives as well. Validation, of course, we may forecast, we may assess if your assumptions or your criteria on which forecasts have been done are not practical or not realistic. And again, if you do not have any access to validate them, actually your value cannot be accepted. Your value is with lots of flows. So therefore, if you can have a kind of observable in the future, not during the entire infinite time period, at least once you have done evaluation. So whether the next year results are in line with the forecast that you have done today. So this kind of review process is needed, especially when we engage in strategic valuation process. That is where strategic management accounting should be able to collect these data and allow and create kind of mechanisms to review, continuous review process. Reviewing is important. And the corrective action should be taken. But it really depends on your purposes, whether you want it or not. But if you want to have some kind of value creations and better performance in your organization, of course, you need to always review what you have forecasted. This parsimony concept is so it has been derived from the idea that sometimes when we try to do something, we are bothered about all the information, each and every information, no matter how significant it is. As long as it is relevant, you may collect. So in other words, there is a tendency of embracing the perfectionism. You want to be perfect. It's all right if you can, but it's not practical. So if you try to be too perfect, you will never ever achieve the objective. So therefore, the parsimony is, tells us to be pragmatic and just deviate from accessing all the information, but look at the relevant and limited information which have critical influence, or they are pivotal for the valuation. That's what we have to do. What drives value? Already I explained last week. In any organization, no matter whether it's business or profit motive or whatever, even social movement, there are many activities, but they can be mainly categorized into three groups. The ways of dealing with finance, that is financing activities. So, so very easily you can refer it to the statement of cash flows. Statement of cash flows is prepared or discloses information about three different types of cash flows: operating cash flows, investing cash flows, and financing cash flows. The reason is that they are the three big baskets of operations that any entity can have. So without having money, financing, so you can't um, run operations, so you can't continue an organization. So it matters. And then they are invested, we discussed. So investment there is intended asset base and structures, you invest that money. So you have the money from owners and lenders, you have channeled those money, capital collected from equity holders and debt holders through different channels. They are investments. Investments are not the ones that you make or have deposits in banks. So they are not investments for entity. They are simple deposits. And then they are put in to operations. We need to carefully check which activities really generate value. The question one is the equity financing. Do equity financing create values? How do you finance or use equity financing to increase the value of an entity? You have learned these things in financial accounting as well. When your asset base increases, right? Increase in assets, if it results in equity, so that is an income, that is a value the creation. So by taking that question, we can ask, okay, then when we issue shares, of course it happens. How? Asset value goes up. Whenever you collect money, you obtain money from your owners, and maybe in the form of cash, or you buy assets or whatever, your asset base goes up. On the other hand, your equity value also goes up. Increase in asset that results in equity looks to be or appear to be value generated, but it's not. That's where you've got to be very careful. So that is the reason why when we define assets, not assets, when we define income, we say, like, the conceptual framework says that, yes, of course, increase in assets, decrease in liability, that would result in equity, other than the transaction between, or distribution or whatever, so defining that. So transaction between entity and equity holders. So that's the reason, right? You exclude it. So always try to integrate the knowledge that you have gathered from different subjects, no matter whether you learn them in isolation, separate subjects, all those subjects are connected to business performance. Then it is easy for you to understand. If you see some contradictions, then you have to question and ask why. You better consult your lecturer or even textbooks, your friends. How come? So here we learned something, but I learned something totally different what I learned in strategic management accounting. How come it happens? Then only you can solve the issue. So first and foremost, then I have to tell you that financing will financing doesn't generate value. Okay, no matter whether you issue shares, no matter whether you repurchase shares, whether you issue distribute profits as dividends, all sorts of things, even redemption of shares if possible, capital reduction, sometimes what we call in the case of bonds and others, like basically when it comes to equity, it's a capital reduction. Whatever the things which deal with equity holders, it does not create any value. But caveat is there, you've got to be very careful. Remember, if you have borrowed, change the composition of the capital structure, equity and debt, return on equity can be influenced depending on the cost of equity. So therefore, capital structure, even though the financing activities do not generate any value within the corporation, capital structure may alter the return on equity compared to return on assets. Return on equity compared to return on asset. Take an example like this. Suppose that there are two businesses, identical two businesses, with total net asset values of 500. One has been fully unlevered, only equity, just started. So total net assets 500, net assets 500, therefore equity 500. Sorry, so we'll take total assets. Total assets 500, no liabilities. So that means total assets 500, liabilities 0, equity 500. Second business is still total assets 500, loans 100, equity 400. You can take any proportion just to give you a comparison. As far as the assets are concerned, assume that the management style is the same, organizational capacities, procedures, abilities, opportunities, all those things are identical. As a result, both companies earned 100,000 profit before tax. For the time being, forget about these tax. And then I'll come to tax later. If you calculate the return on asset of both entities, 100,000 divided by 500, the same ratio. That is what we call return on asset. 100,000, 100,000. No interest also has been there. Therefore, 100,000 divided by 500 is a 20% return on asset. So we can categorically argue and just explain that example, financing has no role to play in or on return on assets. In other words, in generating value or creating value. Now calculate the return on equity in both cases, assuming that tax rate is 50%. So in the first scenario, profit before tax 100, tax is 50, 50,000. 50,000 divided by, still you have equity of 500, right? 50 divided by 500 is 10%. Return on equity 10%. The second scenario, still tax 50. 50 divided by your equity. How much is your equity? 400. So 50 divided by 400 is how much? It is more than 10%. It is 12.5. So somewhere you can simply do the calculation, right? Even apart from this basic comparison, If you take the tax advantage, so if you insert the amount of interest, and if you take the advantage of interest also further, um, the impact on return on equity would be very significant. Now, you must be able to understand that in a situation where you have borrowed money, right? Of course, in the case of second scenario, you had borrowed money, then you have to pay some interest, but interest would be deducted in arrival tax. Then there is a tax savings as well. So for the time being, forget about all these calculations, because our exercise is not to look at in detail about these things, just to get some idea and how the assets create value, and how and why equity financing does not create value. So, but as I just told you, when there is a difference in the capital structure, that would influence the return on equity. Therefore, in case if you want to do a research on capital structure, remember that the place where we have to test is not the return on asset, but the return on equity. Debt financing, the same thing. No matter, so in the previous example, return on asset, your capability is the same. Then what do really create value? Of course, value is created through operating activities. That is a key. If you create your value through your operations, operations are connected to earnings, either general earnings or residual earnings, extraordinary earnings, or whatever. It should be earned. If you receive and increase your value, it's questionable. It does not, it's not substantive to strengthen your position. A good example, a very good example. So always you better in touch with what's happening in the economy, the market, in the politics, society. So that gives you lots of information. So a couple of days ago, central bank announced that its net not official foreign reserve level has gone up to 3.1 billion compared to last month net for official foreign reserve or foreign reserve level of 1.5 billion, which virtually it has increased by 1.6 billion dollars. So reserve level has gone up. Is that good? Yes, of course. Then you have a buffer. When your foreign reserve level goes up, your capability of importing goods and services that you want, your capability of making foreign debt servicing increases accordingly. So therefore, bigger the or greater the amount of foreign reserves, bigger the impact or the capabilities that that particular country has in terms of importation and debt servicing. That's good. No argument about it. But how has it been increased? That's the second question you have to ask. Without asking that particular question, if you simply believe in that and be fascinated, oh yes, that's good, we don't have any problems, right? So some people comment like this. So one of professors from our university, yesterday, maybe yesterday or day before yesterday. So in an informal discussion, now it's a fact that everyone agrees that there are lots of issues in the country. Economy is in a perilous condition, right? It's a fact. It is reflected with lots of symbols, shortage of goods and increase in prices, and people face hardships of finding things. Even lots of fear has created in the minds of people just to acquire basic consumable items. So it's a fact. but you are exposed to this at different levels. But this professor, I do not know whether just he told me this knowingly or unknowingly. Has he just told me knowingly or deceptively to mislead me or to interpret the or protect the government? That's all right. But if he's told me that he is express his views, believing that it is true, it is so dangerous. What he just told me, he said, no, he just, and because he knows that like I'm engaged in politics. Um, you must be knowing now I am a member of executive, member of the National Executive Council of Jatika Jana Balawege. So he also knows that I involved in politics. Then he told me, I do not know anything about economics. Is there a real economic problem in the country? But I didn't say. I think yes, we need to discuss, so we can't say that. And so I didn't comment that much. Then he told me, yesterday I went to a party at Shangri-La. You may not believe all the rooms are booked and all these conference halls are booked. So many weddings are been taking place. Then I came out from Shangri-La. I saw one gold face that the mall people were in queues to enter into. So they are so enthusiastic. I don't see that kind of big problem in the country. So economy is in a way flourishing, like people have money, but lots of news and the propaganda is there that the people are struggling and lots of problems are in the society. I have a doubt whether it is true or not, whether it is something politically motivated propaganda to put like uh, discard the government or to bring the respect to the government and all these things. So just see, then I didn't comment, right? So if I were to come in, it would have taken lots of time. I did not come in. So my conclusion is this. Had he made the statement knowingly that, yes, there is a problem, but he has a different opinion that I have. So therefore, he shrewdly just says something to submerge the protest that comes from general public knowingly, just to divert the attention to general public, saying that there's no problem, it's all right, because always people represent or appear stand by for their own opinion ideas. So it's all right because being a professor. But if he says this, genuinely believing that there is no problem, of course you have to think very serious about the country's situation, right? Anyway, so coming back to the lesson, you got to be very careful when news or information is disseminated. Where in the case of reserves have gone up, but that reserve level has gone up not because of earnings, simply because of borrowings through a swap loan. So 1.5 billion had gone up to 3.102. That's true, but by borrowing money, then it creates another liability, which has to be settled eventually within a shorter period of time. As of now, you tackle your problem, solve your problem, but you are inviting so many other problems soon. If you know the real structure, that why I just took that discussion is, if you do something knowingly all those consequences, it's all right. So that is why when you hear something, better be aware of a full information. So the case of value creation, operations are the value creator. But if you want to increase your cash flows, you can obtain them from equity holders or from lenders. Then your capacity would be bigger, but it doesn't mean that you have created value. Value creation is coming only from operating activities, but mind that operating activities are supported by investing activities. In a way, both investing activities and operating activities together create value. Once it is referred to economics, we can simply say that value is really created in products. Bread, sugar, rice, aeroplane, whatever you can go, you may name any product. So they are products, even services. Factor markets. So we are labor mainly in textbooks. When we talk about the factor markets, labor and other equipment, land, and even entrepreneurship is considered. That is the capital. But truly speaking, if you go to detail, the decalibration of analysis, expand analysis, at the end, you would realize that the factor that creates value is none other than labor. Now, keeping these things in mind, we look at a corporation to value. How are we going to do the valuation? Already now we know that value is created through operating activities which are enhanced or further influenced by investing activities. So as a simple form or simple or basic step, we can look at these cash flows generated from operations as proxies of value. No harm. Already we defined that value is created in operating activities which are supported by investing activities. From operating activities in the financial statements, the result is termed as the profit, but in absolute term, real terms, cash flows or the value generated from operating activities can be seen in cash flows from operating activity. So we'll take it. But if you want, you can take that cash flow and do the valuation. But always, as we discussed, shown in the previous slide, both cash flows generating from operating activities and a connection them with investing activities could create value. So that entities are required to invest appropriate amount of cash flows in investing activities. So that you need to deduct something that is denoted here by I, capital letter I. So concept of free cash flow comes by deducting the required amount of money for investments from cash generated from operating activities. That's what we call free cash flow in general. Bigger the amount of free cash flow, the bigger the leverage that an entity has to deal with financing activities. Of course, free cash flow does not or helps us to create more value. It helps us to deal with financing activities only. But nevertheless, free cash flows reflect the result of profitability, result of value creation. I hope it's clear to you. If it is not clear, please ask. Free cash flow is a kind of leverage that the entity can enjoy because you have that too much. From the operations, it generated 100 million. For investment, 60 million was set aside, 40 million is there. What can the entity do with that 40 million rupees? Yes, it could be either invested further in financial assets, not in operating assets, financial assets, or it could be used to redeem loans, or it could be used to pay dividends, repurchase shares, likewise, either to pay to equity holders or lenders. If the amount is small, what happens? Your leverage is restricted. You are highly living with lots of constraints. So that would build on to financial distress in a corporation if the free cash flow is relatively small. So free cash flow is a big leverage tool. However, if you keep your free cash flow within the entity without dealing with financing activities or using them for financing activities, what happens? It does not create any value, because if you keep your cash in the form of cash, it does not generate any value. Cash does not generate any value. You got it? I hope it's clear. But the cash generated from operation is a proxy of the value creation. I'm just again explaining it to you. Cash generated from operation. So whatever the cash that we have could be used for any purposes. But if that particular cash has come from operation, of course, it is a proxy of your profits, your performance. So therefore, that's good. That is the value creation. But if you have received cash from some other sources other than operating activities, it is not a proxy of valuation. So that is the reason why free cash flow is said to be not creating value. But since it's a result of value created through operating activities, if we want, we can take free cash flow for valuation purposes. We are doing the things knowingly its limitations. Or it's good if you know the time period. In this particular example, just 5. But if it's a going concern, of course, these free cash flows are expected to flow into the business over infinite time period. Then we need to think of a valuation model. Here we are going to use only discounted cash flow technique that is more reliable and objective measure available in terms of fair valuation. There are other valuation models as well when it comes to other valuation, maybe in public valuation, property valuation, motor vehicle valuation. So likewise, there are different indicators and different yardsticks may be available in different fields of valuation. But as far as business valuation is concerned, again, we have different modes of valuation here. So as an objective mode of valuation, we use discounted cash flow technique. Of course, discounted cash flow technique has its own problem. One is the estimation problem. If something goes wrong in the estimation, that would affect the present value. The other problem is the determination of the discount rate. If something goes wrong, of course, that would affect the present value. So the technique here is to determine the value of the business through the present value of future cash flows. No matter whether that is free cash flow, earnings, residual earning, or any other thing. Have you learned discounted cash flow technique in other subjects? Yes or no? Then I can quickly refer to the basics of discounted cash flows. Yeah, please speak up. Hello, guys. I don't hear you. Have you learned discounted cash flow techniques? Anyway, I do not get any response, so can't help, but I'm not in a position to teach you. Just if I knew that, if a further explanation is needed, I could have. So anyway, just as planned, I will continue. Discounted cash flow model takes into account all the cash flows, forecasted cash flows, we forecast. As of now, from here onwards, from today, we expect some cash flows or profits in the next. So this is denoted by cash flows generated in the year 1, 2, 3, 4, 5. All these cash flows are future cash flows and not the cash flows that we have at present. So in strategic valuation, we face a problem. In the normal discounted cash flow model, what you have learned in business valuation or any other fair value calculations, you are given your cash flows or some information is given to ascertain your cash flows, determine the required rate of return or discount rate, then you know how to discount. That's is under different scenarios where growth is expected, no growth, and different scenarios can be taken into account. You do it. It's that simple algebra calculation with geometrics. But here, we need to go a little bit beyond that, where we need to think of the assumptions or a practical situation or entirety within which we do our forecasts. How do we do the forecasts? Suppose that you have the most readily available information is the information that you have in your hand as of now. That's your present information. In terms of strategic values, what value has been created by the entity is your performance shown in terms of finance or any other thing. So since now we come to finance, so that you have performed as of now. So most reliable piece of information. Then what would be the next year's cash flow? Now, with the information that you have and the capacity that you have maintained already, future possibilities, intended investments, likewise, you can forecast in a way. Again, secondly, also you can forecast based on assumption. But if you keep on forecasting for year 1, 2, 3, 4, 5, so on and so forth until n approaches infinite, what would be the precise? 1 minute. The batteries. 1 minute. So luckily that I was able to plug it. I'm sorry. Right? I will explain it again. You can do the forecast as long as in the examination information would be given. In the real life situation, you have to assess information and make some assumptions, whatever it is, no matter how precise your assumptions or calculations, you can do the forecast. But if you keep on forecasting 1, 2, 3, likewise, what would happen to the preciseness of your forecast? Of course, preciseness of your forecast would really fade off and it would reduce over time. The preciseness of your forecast, in other words, accuracy of your forecast for the year 2 is lower than the accuracy of forecast for year one. Likewise, over the time, preciseness reduces. Then we have a problem. Until when can we do so? How do we forecast for infinite time periods? It's impossible. Therefore, we divide the entire time horizon into two periods. Period one is the period within which we can forecast with relative preciseness or more reliability. I mean, the high reliability. In a way, less questions, right? It doesn't mean that they are perfect, but you can minimize the problems that would arise from forecasts. That particular period is called explicit time period. Explicit time period. In the past, for strategic valuation, even in other valuation, 4 to 5 year period. That's the reason why 5-year period is normally taken as the medium term time horizon. So you can precisely forecast for 5 years. Even now we can, but the preciseness is the question. So due to the development in technology and complexities in businesses, different modes and that and this time period is gradually reducing. So from practical point of view nowadays, it's good if you can reduce that time period. If you want to have it as 5, you need to have very good information, and your information system provide these things. Otherwise, you can't simply judge based on arbitrary judgments. If you do these things, that would carry lots of flaws. So reduce. My argument is this explicit time period is becoming now 1 to 2 years, maybe 3, not more than that. However, if you have this, the rest would be called implicit time period. That means during the implicit time period, we make general assumptions which are not realistic to great extent, with lots of uncertainty. So, however, since we have two types of cash flows within the explicit time period, cash flows within the implicit time period, we discount them, calculate the present value separately, combine them together and determine the value. So this is how strategic valuation is going to be done. So then what we do, if we use free cash flows is a result of all the assets. The free cash flow is the result of all the assets. So therefore, it explains the enterprise value, not the equity value. So that in order to calculate the equity value, you need to deduct debt value. That is the reason why here we use this particular formula. Equity value is equivalent to value calculated based on free cash flow minus value of debt. But if you have taken, so if you take the valuation, here take all this free cash flow minus this value. But if you have taken here any other things, earnings or residual earnings, which I will explain so soon, they need not to deduct this, because that reflects only the earnings which belong to equity holders. In financial management, these earnings can be recognized from ultimate shareholders' perspective, that is nothing but the dividends. Then the dividend discount model also can be taken, but its applicability is questionable. However, it is, if you take the dividend as your earnings, your determinant, that value is the equity value, need not to deduct debt. So we face a problem, however, no matter how the formula works, here we face a problem when we value the cash flows or calculate the present value of the cash flows generated or expected to generate during the implicit time period. So it's a technical problem. We will look at this, or I will explain it with this example. Look at this example. Numbers are given in dollars, whatever, you can assume many, and but millions, so that's not that important. And per share numbers as well, right? Required rate of return for the firm is 9%. Normal growth from 27 onwards is 5% for infinity. So can you calculate the growth rates from 2023 to 2026, just 1, 2, 3, 4 years? What's the growth rate? Calculate and post it in the chat box. Here you have to take the growth rate of what? We are going to do the valuation based on free cash flow. Free cash flow. Can at least someone, because if you do not do the calculation, it's extremely difficult for you to understand the concept. Okay, then you do the calculations later. Only thing what I can tell you is that different growth rates can be seen during this particular time period from 2022 to 2026. From 27 onwards, 5% growth is expected until infinity, forever. So that dividend growth model can be applied from here to infinite time period, that is infinity. But we can't apply the model from 2022 to 2026, so that the present values of future cash flows are calculated individually, separately, or as standalone cash flows, so that the present value of expected cash flows in, or the free cash flow in 2022 is this much. So likewise, these calculations, these are the present values of cash flows expected up to 5 years separate. The summation of these 5 cash flows amounted to 14,367. If you do not do the calculation, so it would be extremely difficult for you to understand, but I can't help. It's up to you, your choice. I don't mind. Right. The later on you can't, in case if something has gone wrong, you will live with that error and you will not be able to rectify it. Anyway, so we'll proceed. The cash flows from 2027 to infinity will be, this is the free cash flow for 2026. This should be inflated by 1.05% in order to have the cash flow for 2027. So it would be like this. The cash flow for 2026 is 5,311 multiplied by 1.05 is this much. It should be divided by R minus G, that is the growth rate. Simply speaking, these four components or the values we have taken here are the values substituted for the dividend growth model. In the dividend growth model, it's a constant growth, it's a 5% that can be applied only there is a constant dividend growth. So dividend growth is constant. Then next year's cash flow, next year means 2027, we stand somewhere there, 2026. So next year for 2026 is 2027. Then we simply disregard the rest. This that has been, the present value has been separately calculated. The present value for the cash flow starting from 2027 to infinity is done separately. So here the present value is as of 2026, end of 2026. Here, the present value is as of now. So for that, next year's cash flow is this much divided by R minus G. R is the required rate of return, minus G is the growth rate. Therefore, 4%, it gives you this much, 139,414. This is what we call continuing value. Continuing value. That means the summation of present values of all the cash flows starting from 2027 to infinity. That's the meaning. But its time horizon starts from the end of 2026. Therefore, this continuing value is as at the beginning of 2027, because we consider 2027 values, end of 2027, that means the present value is beginning of 2027. Here, end of 2022, the present value of 14,000 is the beginning of 2022. That means end of 2021. Here, the cash flows starting from 2027 discounted, then it gives you the present value as of the beginning of 2027. That means end of 2026. This 14,000 is end of 2021. Therefore, the continuing value of 139,414 has to be brought back to as of 2021. That exercise is a normal discount. In other words, this continuing value of 139,414 is a cash flow. In other words, I can interpret it in that way. Cash flow, net cash flow generated at the end of 2026. 1, 2, 3, 4, 5. After 5 years, if you consider today's situation, this is a cash flow expected to be generated after 5 years, so that you have to discount it. 1 plus R to the power of 5, not 6. 1 plus R. So discount rate is 9. Therefore, 1.09 to the power of 5 should give you this value. So 14,000 plus 90,000 becomes 104,000 something. That is the enterprise value. You see, that is not the equity value, enterprise value. No matter how and who have financed it. Okay. From the enterprise value, you deduct the book value of net debt. That's simply given. So the value of equity is this much. since the total number of shares, just assume number has been put there. So value per share is this. So this is, we do the valuation for strategic purposes. Actually, this calculation is not a big deal, but the discussion associated with this calculation is the most important thing. So you have to do extra personal efforts of learning. Since there are no interactions, I also can't help that much. You need to think of explicit time period, implicit time period, how rates are determined, the significance and importance of all those calculations to do a strategic valuation. Again, little bit explanation. Already I explained why free cash flows cannot add value or create value, because this is mistakenly interpreted. Bigger the free cash flows, higher the leverage that an entity has. No, it's not. Yes, of course, that's true, but free cash flows do not create value. The cash flows from operation, already I just explained you, is the reduced by investment. You see this kind of paradox. The free cash flow we take to do the valuation, but the level of free cash flow either increases or decreases depending on the amount of investments. Greater the investment, lower the amount of free cash flows. Fewer the investments, bigger the free cash flow. So therefore, your free cash flow, I mean, in an entity where investment is kept to be minimal, then you show relatively high free cash flows. You may argue now, then, yeah, then value would be very high with little investments. Is that clear? You have big amount of or significant amount of cash flows from operating activities. You set aside fewer amounts for investing activities just to keep the free cash flow a little bit high, and you deal with your financing activity. Based on the argument, now you have big free cash flow. For the valuation purposes, you take the free cash flow, that would give you a better result. No, it would happen only in the year 1, 2, or 3. If you keep on reducing your investment, what happens? Of course, the first one would be eventually affected negatively. Cash flows from operating activities would reduce if you keep on reducing investment. So that's the beauty. You have to understand it. Yeah? So you can't do manipulation. So that's the reason why investments are regarded as something which would contribute for the growth of a company. Bigger the amount of investments or reinvestments, greater the expectation for growth. You can expect more growth. Of course, these investments should be productive. If you simply invest your money in unproductive or wasteful project, so that's not good. So value received is not match against value surrendered to generate value. So that's why the value received is coming from operation. Value surrender would be there with the investment. We are not going to match it. We finally take the free cash flow on the assumption that over a longer period of time that would be reflected. Hence, a firm reduces free cash flow by investing and increases the free cash flow by reducing its investment. So stand only for 1 year. Over the time, so you would not be able to maintain that particular consistency. So free cash flow is partially a liquidation concept. In terms of the appropriateness of valuation, business valuation, if we can go for some other elements rather than free cash flow, that would be better. Why? Free cash flow is basically taken as a good concept for liquidation purposes. What are the alternatives? The other alternatives are earnings projection. There are 2 types of earnings we talk about here. Number 1 is the earnings, the normal earning that you see in your income statements, profit for the year. But the earnings, when it comes to earnings is of course a reflection of the cash flows, but there is a possibility that you may have learned these things. Earnings can be manipulated through accounting tactics by using accruals. Because financial statements are prepared on accrual basis by using accrual concept. There is a possibility. There are some other possibilities as well. Real or physical deferments of expenses, income, that and this. Always accounting is a subject where plenty of rooms are left with managers, those who have access to information compared to other stakeholders. There is a chance that information could be manipulated. That is one of the best tools to reduce this manipulation, or the possibilities for manipulation, is the integration of technology and creating an environment or the mechanism which allow all the stakeholders to access to information, shared information. But you know, in a market economy, always they come out with an argument saying that confidentiality, we can't do this because we engage in fierce competition, whether it is true or not. So lots of arguments are there by leaving the ability for managers to manipulate earnings whenever they have their own desires. The other concept of earnings is the residual earnings. Residual earning is even if you manipulate your earnings, residual earnings cannot be manipulated over a longer period of time, because it's a consequence of your real actions, and it's a consequence of your real investments, investing activities. Both go together hand in hand. So therefore, we can move to residual earnings to strategic valuation if we want. What is meant by residual earnings? In some textbooks, this residual earning is defined as extraordinary earnings, exceptional earnings, and sometimes called abnormal gains, not gain earnings, something like. The concept is very simple. Concept is, being an entity, a corporation, you have your own expectation based on the readily available information. You have a certain amount of capital invested in this business. You have your own capacities, capabilities, that and this and everything. And then you expect something. So referring to the required rate of return, sometimes that could be measured through a capital asset pricing model or any other model, or whatever it is, you have a fair calculation about expected rate of return, Then apply that expected rate of return to the capital that you have, equity that you have been maintaining in the entity. That is what we call expected return. If this expected return match with the actual or forecasted possible returns on equity, that excess is the residual earnings. Assume that expected rate of return is 20%. We'll take in absolute numbers based on the asset base. So we expect to generate 100 million. It is not a forecast. Expected based on required rate of return multiplied by the equity. Therefore, final expectation is 100 million. But you can forecast your earnings, where you have to make realistic assumptions about your operations, capabilities, and the other contextual factors, government policies. Likewise, you take into account all, you may name, and you forecast. And if there is a difference between that, so then if you forecast 125, your expected amount is 100, the excess of forecasted ROE, that is 25 million, is the residual earning. So then we can calculate the residual earnings for the same time period, do the present value, I mean calculate the present value, that is the value of equity. Within the business, like in strategic management accounting and business valuation and others. So still lots of debates are there about uh, pros and cons of each and every method, but still residual earning, the valuation based on residual earning is considered to be superior or more robust compared to other variables. So that we can say, so that is the explanation here. And the growth in book value. The other one is, instead of looking at these residual earnings or ROE, we can look at the growth in book value. This also has a reason, an argument, a kind of justification. Book value. Book value of what? Book value of net assets. If the book value of net assets go up, book value goes up, what happens? It can go up due to two reasons. One is to increase in equity due to contribution or earnings. So the indirect argument is increase in book value is characterized by increase in value generation. But we need to make appropriate adjustments where there is no such value generation. However, as a proxy, we can take growth in book value as well. But in case if you are asked which one would be more superior, residual earning or growth in book value, of course, the residual earning would be superior, because the growth again can be manipulated by manipulation of earnings to some extent. However, that can be done only for a couple of years, not all the time over the time period, because once the book values are inflated, in case if we argue that values also can be increased through manipulation. So if you increase through manipulation, what happens? Once you keep on increasing your asset base through manipulation, what happens? Expected return will increase because the asset base goes up. Then entity will not be able to generate a significant amount of residual value. So anyhow, though the possibilities are there to do manipulation, some or other ways, there are some other opportunities for us to catch it and detect them. So that paying too much attention on earnings growth will also create problem. Investment create growth, but does not necessarily add value, because there would be some growth just temporarily in assets, but those assets are not generating cash flows, value is not created. That is the danger. That is the reason why, just take this particular point, you must have learned a different discipline or the subject area called capital budgeting. Now you can understand why capital budgeting is so important. For investment appraisal, if you do something fundamentally wrong in capital budgeting or investment appraisal, of course, this is the consequence. Investment, or there is a growth in investment and assets, but they do not add value to your entity. Earnings growth can be created by accounting, already just explained you. Need a valuation method that protect us from paying too much for earnings growth. So finally, though we can take the earnings growth, earning growth is also interconnected to the earnings, then I can conclude that earning based valuation is much better than other form of valuation, despite the fact that it has its own limitation. So this is the explanation how and why too much focus on earnings would create problems. Just see residual earnings before new investment is 10, hurdle rate 10%, so that we can calculate residual earnings on the assumption that return equity is 100 into 10. Sorry, 12 is the actual earnings. Then the expected earning is this much, that is 100. Sorry, 10, 100 into 10%, 10, 12 minus 10 is 2. So ROE, return on equity, is 12. Simply speaking, then you can say as a percentage, residual earning is the difference between ROE and expected rate of return. Then the residual earnings after new investment of $20, so $20 million, earning at the same percentage. What would happen to your residual earnings? So if this new investment will give you the same return at the rate of 10%, 10% of 20 is 2. Then 2 plus 12 becomes 14. So 14 is this much. Now you need to calculate the expected value of expected earnings, that is at 10%. Your base, because of the increase in asset base, earlier it was 100, now it is 120. 120 into 12, sorry, 10% is 12. 14 minus 12 is 2. So now you can compare this particular residual earning with the expected earnings of this additional investment. Expected earnings of the additional investment is 20 into 10% is 2. So residual earning also has increased by 2. So 2 minus 2 is 0. So new investment has not created extra value. So creating earnings by accounting method also increases the residual earnings, but reduces the book value, then the net effect is 0. So that's what I just told you. Even if you tend to manipulate the book values of investment by increasing the growth, you can do it only in 1 year, but in the following year, it would be matched or cancelled off. Sometimes you better learn this separately. The significance of price earning ratio. PE ratio is the relationship between price and earnings. If we too much focus on earnings, high earnings would again influence or drive the high prices as well. But when the earnings change, price earning ratio also will change. So accordingly, the valuation may contain or entail some errors. Forecasting template, I'm not going to go through this template in detail, but just simple steps I will explain you. Whenever you want to do strategic valuation, the first question arises as to when and from where should we start? When should we start and from where should we start? There would be so many arguments. We can start from that and this and with that and value base and assumptions and so on and so forth. But truly speaking, no matter how you argue and justify different dimensions of business components, finally, the value will not be able to be materialized unless you demonstrate all these efforts in your revenue sales. So it is the best way to forecast sales based on the best available information. Starting point is when you have to decide. Then you have to forecast return on net operating assets, asset turnover ratios, and other different calculations. Based on these expectations, you can develop other values. You can ascertain other values whereby referring to the existing statement of financial position. You, of course, you have to take your base is the zero, that is the existing financial statements, then start forecasting with sales. Then you can forecast different elements. Some entities you do not have so complex business operations where only one profit margin and one core business. The task would be easy, like in an examination. But in the real life situation, that would not be that much easy. Different profit margins, different core business units, strategic business units. So likewise, so they operate with conglomerates, they operate with an umbrella of companies. Likewise, so many complications can be seen. Then either you can reach to free cash flow or earnings or residual earnings as you wish. Then the dividend payout and all those matter when you think of investments. Then you have to calculate net financial expenses as well. And don't worry that much about these formulas, because this has been taken mainly from financial perspective, but strategic management accounting perspective, we have to focus on its significance and its drivers, its applicability, and all those things, not that much on calculation. So even when it comes to calculation, interpretation matters and not the detailed accounting calculation, because we do these things in a separate place. So finally, we need to do your evaluation based on appropriate assumptions. Now I will take maybe sometimes to discuss about alternative approaches to strategic management accounting through value creation, value models. But before that, if you have any question, you can ask. Yeah. Few minutes. All right, we'll start. Alternative approaches. Why do I have to talk about alternative approaches first? The main reason is in dominant discourses and in almost of all the materials that we have access, such as textbooks, presentations, or any other write-up and case studies, and wherever we have access to these kind of things about strategic management or corporate world, the dominant ideology is based on this traditional approach, which is really uplifted and just enriched by the capitalistic model, where individual success is highlighted, simply hiding the contribution from others. Even if you take the success of a CEO, a manager, or one investor, shareholder, having trillions or billions of wealth, if you do a careful analysis, actually that person has not individually earned that much. Good example, if you take Elon Musk, who is considered to be the world's richest person as of now, as an has amassed a huge wealth. Has he earned that amount individually with his own efforts? It appears to be like that, but it's not true, because all arrangements that he has, corporations, business engagement, so many other people contribute, employees, customers, and so that person has been given a kind of opportunity to exploit all those things in such a manner, sometimes legally, sometimes through their own business conduct, so on and so forth. So you do it, but not with your own efforts. We can't simply produce these cars or rockets or any other products without having the contribution from others. You got it? So legally, you work together, but finally you claim that you work individually. This is an inherent characteristic of this dominant model. Because of that reason, other alternative approaches are not discussed. We discuss only competition and value creation, and where individuals can create value, and whoever who are highlighted and whoever who have power in the organization are rewarded accordingly. That is the reason why huge bonuses and benefits are given to CEOs and top managers, whereas only peanuts will be given to low level employees such as clerks, janitors, and all. Even so, that is how it is set up. However, it has its own limitations. So we have been practicing these models, especially in the strategic management accounting, also in the information uh, use of information in strategic management. We have been doing this thing. However, it has created its own problems and challenges. As a result, many organizations throughout the world now have at least started talking about different alternative models or ways of conducting strategic management accounting and doing businesses. And some countries and some organizations have been already able to adopt alternative methods and been able to plug the fruits of this or gain the benefit of these things. There could be other alternative methods as well. I would like to highlight few of them. One is the concept called integration versus disintegration. So so-called disintegrated approach of maintaining strategic business units or departmental approach or individual approach has created lots of problem. Now there is a tendency in the world, no, we need to look at all these things through integrative approach. It's difficult to distinct or identify the contribution of separate unit individual distinctively. At the end, it's a result of collective efforts summarized. Different collective efforts can be identified. So at least if we can go up to that level integration of separately identifiable collective efforts, then that might pave a way for businesses, especially in strategic management accounting, to create value at a higher rate than it has been doing as of now. The second one, though I have just taken this as an alternative approach, it's not that new. It's been practiced in other countries, teamwork versus individual, especially in Japan, in European countries. Even now, the idea has moved to Western countries. Here, idea is seen only in textbooks. When it comes to real work, I do not see that much teamwork in our corporate world. Lots of rifts can instead lots of rifts can be seen even within the same, not within the same entity, Entity also has different units, departments. Even within the same department, lots of threats are there. Very difficult to implement information sharing culture. Why? You are rewarded individually, not as teamwork. However, if you can promote teamwork against individuals, lots of even research have found that more value can be created than promoting individual value maximization. The other one is the cohabitation against the competition. It doesn't mean that we should not compete, because it should be healthy competition. It shouldn't be fierce competition to kill others. If you promote too much competition to kill others, even the objectives of the competition cannot be achieved. So that is what the societies have proven as of now. Competition is taken as a good concept which allows us to be creative and be more competitive, so that we can come out with more creative ideas. That could be the reason, I suppose, why the father of economics, Adam Smith, promoted the competition on the belief that competition would lead to have goods and services produced at the lowest possible cost in this world, and with the highest level of efficiency, which is driven by appropriate use of technology. That could be the reason. So that's my interpretation. But what has happened as of now, competition has not been able to maintain its basic principles intact, whereby allowing everyone to engage in economic activities in a democratic and fair manner. Instead, the power that one entity or big corporations have gained over time is being utilized to cannibalize others or kill others, or and create an environment where either direct or indirect monopolies are being created, or oligarchies are being created. Even in Sri Lanka, you can see this situation in different industry, tile industry, the rice market, even paddy, basic, once you just do the harvest, even agricultural produce, even fisheries industry, wherever you go, individuals may produce, but when it comes to the last, like marketplace, you see monopolies. That is the reason why they can create shortage of goods in the market and increase the price. This is what's happening as of now. The one of the biggest problem now we are facing is the increase in the price level, general price level. This may, we do not know when and how, when it depends, may like end up with even hyperinflation. No one talks about increases in price. Why? These oligarchies and monopolies have been able to create another issue amidst the increase in prices. Prices of gasoline increased, price of domestic gas was increased, and continuously daily basis prices of all the other essential items such as vegetables, all those things increase. And recently the prices of milk powder uh, was also increased. So likewise, of course, there is a concern that prices are going up. But what is the biggest issue that people talk about? Shortage of goods. People are in queues to buy the 1 cylinder of domestic gas. So if you can find one, then that is an achievement, right? So if you talk to one of your friends, or if your friends or whoever say, oh yes, I was able to buy a gas tank, then that's a big achievement. But no one talks about that you have paid relatively high price. So likewise, tomorrow you may enjoy, you would be joyful to celebrate that, oh yes, even your parents, yes, I was able to buy a packet of powder without being in a queue. That would be a big achievement. So you see how the attention of people are diverted to unnecessary ends in the name of competition, whereas there is no real competition in the market. What we see is the monopolies and oligarchies. So alternative concept, this thing is to make certain and different types of alliances, collaborations, and all those things. That is what we'll call cohabitation. Cohabitation, this happens only a particular democratic environment, and conducive business environment is created where everybody can take part in the businesses and democratically uh, with understanding, even information sharing situation, then everyone knows what's my share of contribution and what would be the most appropriate amount of benefit that I should claim from that. This is a cohabitation, but the cohabitation can lead to a system such as JIT, what was seen in Japan, likewise. Then the value creation, performance evaluation, and rewarding is done now. New trend alternative is done purely on collective efforts, team efforts. This is the new trend against the individual performance evaluation. And the most newest concept of the organization, structures of organization, form of organization, this is very much popular in Europe and being introduced in the United States as well. Worker corps. Worker corps is a kind of organization structure where all the big stakeholders who directly engage in the course of production have the opportunity to take part in the management, either as a representative or any other different model will have to be discussed. This is very popular, so that you can eliminate unnecessary conflicts between employer and employee. This is not that easy. This would happen only in a society where we can establish the trust among all these stakeholders, even the guidance and genuineness of political leaders. Lots of things are there. However, the worker corps enable all the stakeholders to take part in the business activities in a fair manner and claim for a fair share of benefits arising from the value that they create. The last one, I will explain a little bit more. The not Mondragon, actually one spelling mistake, the Mondragon. It is actually initiated as a worker corps, but now it has grown to a big conglomerate in the United States. This is considered to be one of the, not the one, so the biggest conglomerate which has adopted these alternative approaches throughout all the management sections by adopting the concepts of these. Initially, it was work group, now it is conglomerate where highly or relatively democratic aspects are seen, and it has been extremely successful. Mondragon in Spain started with just less than 10 employees to run small businesses. Now the total number of employees has increased up to 80,000 or 90,000, huge. And it has foreign subsidiaries as well, and lots of networks within Spain. And it has stepped on to different types of businesses, business diversification. It has its own universities as well, you may think. So which is mainly, when it comes to universities, the motive is not to earn profits, just to develop human resources required for the Mondragon Corporation in with high caliber competencies and talents which can be gained in any other university. So that university has become so famous. There are lots of outside invitation to enter into that. So some provisions may be there, but main purpose is to provide a better education. I just want, if you have free time, just go to the internet and look for Mondragon and look at more details. But I would highlight major information pertaining to strategic management accounting and rather management where the value is created. Just look at this, the image of a house. That is the vision. Even the competition has not been simply ignored. This is what we call healthy competition, competitive, profitable, and entrepreneurial cooperative group. Just look at it is not cooperation, so limited liability aspect. Limited liability company. This is a limited liability company, but it's the approach is cooperative group. So they cooperate together. Even in a limited liability company, the cooperation is there. But this is something like cooperative approach. Just go to the bottom, principles and values through a management model as a competitive advantage where they take into account sense of corporate experience, the learning by doing things, corporate experience. You come out with new innovation, new learning, and that would enhance the earnings of the company. Then new corporate management model, which I will discuss after this. Then basic cooperative principles, values, mission. Then these are the key or the basis on which the value is being created and other things are put up within the Mondragon Corporation. Then they introduced a concept called intercooperation, innovation and promotion, and globalization. So that has not been ignored. So either we like it or not, now we live in a global society, so that you can't claim that no, we will produce goods and services required for us only. No. So you need to take into account what's happening in the world. So Mondragon very rightly takes those things into its dashboard. Value added employment. You see, employment is just not for the mere namesake of doing some task individuals. It's value added, connected to each and every employment and in a sustainable manner by connecting to the community as well. So this is only, this is how the Mondragon has been able to maintain its success, has been able to be competitive and create value through cooperative or collective efforts. Its management model is very interesting. The core of the management model is the cooperative principles. So not the rules, not the regulations. So you take decision based on certain principles. If you go to its website, you can check all these things. I'm not going to read out all these. So what I want to highlight here is, if whenever you work or carry out something based on principles, that is objectively principle based, something would always help the managers or whoever to run the businesses objectively, because the biasness can be eliminated. So they give priority to people. They are their employees, not only the employees, customers, suppliers, likewise, whoever who associate with the operation of the Mondragon are the people. Incorporation, so connection. This is the like the integration, whereby joint project can be run. So these joint projects are not simple joint ventures where just everyone tries to maximize their profit. This is really based on sharing information. To great extent, now Mondragon uses the technology as well. The participative organization. So participative organization means like stakeholders take part in all the like engagement. Then socio-entrepreneurial results. You see, not only the entrepreneurial results. The most of the cases when we think of businesses, even nowadays we talk about other aspects, society, environment, sustainability. But if you carefully analyze in detail with those organizations, what happens? So these things, even corporate social responsibility and all other things are used for propaganda purposes, and their prime objective is to maximize the profit. But here, it is not simply stated in the document, but also the practice. For example, the maximum gap between the benefits level, salary level, between the highest competent employee and the lowest competent employee is 8 times, not more than that. But in the world, in Sri Lanka, this gap between the lowest and highest is 4,000, 5,000 times. Now you see how the corporations contribute to create income inequality, income distribution, unequal income distribution in the world. But this is something different, alternative. Basic the cooperative principles. So quickly look at the principles. Where is the core? Core is the education. The priority has been given to education. So that could be one of the reasons for its success. Education empowers employees, develops human capital, increases or broaden the competencies, broaden the capacities of that organization. And it has proven it is not just mere sake. That is the reason why they started their own university. Had this concept been followed by a country, the country has to give the priority for education. Education is not to be sold. Education is to empower people with more creativity and more enlightenment abilities of seeing the world, questioning the world. So that is the purpose of education. So then the sovereignty of labor. This is the reason I just explained. If you decalibrate the value of a product through the information that is generated from strategic management accounting, ultimately you can see 99.9% of the value is connected to labor. So therefore, sovereignty of labor is highly regarded and connected to education. Then it moves to the next layer, instrumental and subordinated nature of capital. So capital also is not taken as something which can be used in the businesses as a mode of finance and big return should be given to them. No, it is the subordinated nature of capital. So it is not considered to be superior, but subordinated and as a supportive element in the business operation. That is the reason why it has been kept somewhere there. In traditional organization, that is the core. We take the capital, finance here, profits here. Then democratic organization, opportunities are given to everyone. Open admission, very clear, like no identities. You see, we maintain these identities even within the departments, universities. So take your degree program. So we belong to university, right? So therefore, everyone in this university should behave with that sense to uplift the value of the university. But when you talk to individual lecturers, students, staff, others, actually, no, we don't have that sense. We have our departmentality. Departmentality. So you belong to accounting department, you try, okay, I want to be the number one, right? So when you try to be number one against others, so value of the university would be lost. So you understand. Again, within different courses, individuals likewise situation. So then this would expand to the market as well. Whenever you hold a big position in public sector or private sector, then you favor If someone comes from the University of Sri Javardhanapura, no. If you hire a person just because she's or he or she is from University of Sri Javardhanapura, so that is not open admission. You might say, oh, you may be proud of doing this, but in terms of value creation, so that is really dangerous. Participation in management. So everyone, including employees, should be allowed to take part in the management. Wage solidarity. I just explained this one, how they have been maintained this wage solidarity. The final circle, the broader circle, takes into account other aspects. Universal nature, of course, the globalization, intercooperations with all the other partners, entities, the whatever, and social transformation. So finally, all the end results of all those operations should not be for any other things but for the humans. So this is how the basic principles have been laid down. And of course, Mondragon is a corporation. They work according to these principles. The good example. Reason is there are no owners there to take the profits out. So it is a kind of um, organizational structure. Benefits are shared, but not one or two individuals to claim that, so I'm the highest, or the one who has earned lots of, like in our cases or in other countries, CEO or the shareholder, one big shareholder is accumulating wealth over time. I think that's all from my side. If you have any question, you can ask, but I know that no one will ask questions. So I'll just summarize it in few minutes. In managing business value and strategic valuation, what I just discussed, the importance and significance of value, whether it is created or generated within an entity. So of course, I just explained it is being generated in numerous ways. It doesn't happen overnight. It doesn't happen in isolation. It happens, it is generated through a complex processes, connections of networks, by using different types of resources. So where in order to provide the incubation for this thing, firm or limited liability corporation has been created. So therefore, limited liability corporation is an ideal organization to really create values. And different ways of value creation were discussed, and the problems of value creations were also discussed. It's both positive and negative, the situations were also discussed. Even the value is being created differently, even in significant amounts. When it comes to strategic valuation, we need to look at the value from the holistic approach. That is why we discuss about business for the holistic valuation, where enterprise valuation and equity valuation. It also can be done by using different methodologies, but here we used only discounted cash flows. Discounted cash flows deal with estimated cash flows. So how best we do the estimation? So that also has become extremely difficult task. Then we discuss a particular concept called explicit time period and implicit time period. Then the forecasts are done with the best knowledge that we have, and to minimize the weaknesses or problems that the discounted cash technique has, and to derive present value of the cash flows that would be taken. It doesn't mean that that's a value that would be taken as a base of the either enterprise value or equity value for any other purposes. So that is the model we have been experiencing to great extent in Sri Lanka in different courses, especially in management. So when it comes to strategic management accounting, how best the information is being used to create value through accounting processes. So alternatively, I just explain you different modes of organization and different aspects of value creation and how they could be taken in the course of strategic management accounting, because Strategic management accounting cannot look at the alternative modes of organizations and ways of doing things in the same way that it was dealing with the traditional or concept, like, yeah, in a way we can say traditional or dominant mode of organization. There could be so many other different models as well. So finally, what matters for organization is now value can be really created in firm structure, organization structure, but its enhancement really depends on how democratic the organizational structure, how collectively you contribute for the value creation, how fairly the created value is being distributed. These are the questions left for the people to address. So with that, I conclude and just wish you all the best for the next year. But it's not me, like everyone wishes. So, but mere wishes may not change anything. But if you determine to look at the society from a different perspective with kind of determination and courage to change things and learn things, of course, you would be successful in the society. So you would be able to contribute for a common cause to create a better society in which everyone can live in harmony. Why I'm just telling this to you, you guys are in the course of learning. As shown in the Monroe Gun Corporation, education plays a key role. Education does not mean that getting a degree or reading or by hearting something and just capturing knowledge and showing that I'm educated. No, it has very broader meaning. I can't explain it in a few minutes, but finally, I can conclude by saying that education is a key that can really shape uh, the uh, the nature of mankind and the nature of the future society. I wish everyone to to engage in that process and contribute to create our own world. So sometime this may be, yeah, my yeah, this is my last lecture for this. Sometime we may see each other in other subjects later on. But this is your last semester, I suppose. Maybe in research, or so Sri Lanka is a small country, we may see each other. Okay, thank you very much. All the best. With that, I will wind up. Bye-bye.